Happy evening to all of you. Welcome to today's CPE meeting on accounting standards for non-corporate entities series 1. May I request delegates who are seated on the back to come forward and occupy the front rows. Since it's a very limited audience, there are about 80 registrations today. Not even 50% have turned up. Today we are going to discuss three accounting standards: AS1, AS2 and AS7. AS1, disclosure of accounting policies. This standard requires companies to disclose their accounting policies in their financial statements. It provides guidance on the selection and disclosure of accounting policies and helps ensure consistency and comparability between financial statements. The other standard, AS2, valuation of inventories. This standard sets out the principles for valuing inventory in a company's financial statements. It provides guidance on the methods of inventory valuation, such as FIFO, first in first out method, LIFO, last in first out method, and weighted average cost method. And the third one is AS7, construction contracts. This contracts provides guidance on accounting for revenue and cost associated with the long-term construction contracts. It requires companies to recognize revenue and cost using percentage of completion method, which estimates the percentage of completion of a contract based on the stage of completion. To throw more light and clarity on the above accounting standards, we have with us today CAP Shankar Raman sir. On behalf of SIRC of ICAI and all the members who are presented here, we welcome you, sir. With a big round of applause, welcoming Shankar Raman sir to come and occupy the dais, please. We will start today's proceedings with the invocation of ICAI motto song. Please raise for ICAI motto song.
Yaesha sukteshu jagrati Yaesha sukteshu jagrati Kamam 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 Pursho nirvimana Tadev shukram brahma Tasmin lokaha sarve tadunātyadi kaścana etadvaita
Thank you. Please be seated. It's my privilege to introduce today's speaker, P. Shankar Raman sir. Shankar Raman is a qualified chartered accountant with about 28 years of post-qualification experience. He has extensive experience of leading and coordinating large national and multinational audit engagements. His area of specialization includes audit in financial service sector, manufacturing, power, retail and distribution, and consumer business. His experience also includes managing a couple of initial public offerings, performing financial due diligences and internal audits. He has hands-on experience in IGAP, Ind AS, IFRS and US GAAP. He has done audits under auditing standards generally applicable in India, international auditing standards, US gas and public company auditing, accounting oversight board standards. With this brief, I present before you Shankar Raman sir to handle today's session on the three standards, AS1, AS2 and AS7. Before I hand over the podium to sir, may I now request CAK Raghu to come forward and present a memento and a silk shawl to Shankar Raman sir as a token of our love and affection. Over to Shankar.
Thank you. So good evening, everyone. Thank you, SIC, for the opportunity given to me this evening to address this August gathering and discuss on three accounting standards, AS1, AS2 and AS7. It's always a privilege and pleasure to be here and to discuss any topic, be it accounting standards, be it auditing standards, etc. So let me try and do justice to whatever introduction was given by SIRC on the various standards, a very brief introduction. So before I deep dive into the actual standards, I thought let me spend some time to discuss about applicability of accounting standards per se to non-corporate entities. So let us spend some time understanding what are the non-corporate entities, how are the accounting standards relevant to them, why should accounting standards be relevant to them, spend some time on that and then probably get into the technical aspects of the various standards. Again, this, as you would have seen the newsletters, it's a 3-day session covering about 9 to 10 standards. So I'm sure that at the end of the 3-day program, we would be conversant not only with the accounting standards requirement, but also understand how this would be practically implemented when it comes to non-corporate entities. So what we'll be covering today would be just have a discussion on what do we mean by non-corporate entities. There are certain classifications given by the ICAI on how to classify the NCEs. We will talk about that. Then we will talk about the applicability of the accounting standards. What are the relaxations available to NCEs from an accounting standard perspective, and then deep dive into the technical aspects of AS1, AS2 and AS7. See, as we all know, we are used to auditing companies, partnership firms, proprietorships, HUFs, trusts, societies, etc. So broadly, from an accounting standard compliance perspective, this is classified into two categories, corporates and non-corporates. So corporates would include companies registered under the Companies Act as well as the LLPs registered under the LLP Act. When it comes to non-corporate, other items would come into picture. See, as we all know from our practical experiences in India, it's just not corporates which have been growing over the period of time. We have seen lots of non-corporate entities. It can be trust, it can be HUFs, it can be individuals, it can be partnership firms, which have also grown a lot in terms of size, in terms of complications, and in terms of importance of it to the nation's economy. So it's just no longer a corporate world. We all from a corporate world understand the importance of complying with accounting standards. Okay, because as said in the introduction, there could be accounting policy choices which are available, and we had implemented them on a day-to-day basis when it comes to corporates. But recognizing the importance of how NCEs plays in the overall economy, there have been quite a few initiatives taken by the ICAI to make accounting standards either mandatory or optional for compliance by this NCEs, so that once people look at the financial statements of the NCEs, there is some base which is set up, because we are used to, again going back to the example, seeing accounting standards compliance in a corporate company. Say for example, if they say inventory is valued at FIFO method, we all understand what FIFO is, how does it work, and we will be able to appreciate the number of inventory which is shown in the balance sheet. But NCEs, to start with, at the initial stages, did not have any specific guideline or regulation. So, which meant each one of them was following their own principles. So comparison was not possible wherever there are data available, and also it was not possible for the reader to understand the financial numbers because there was an absence of consistency. So these were some of the background on why I felt ICAI can come out with initiatives to make accounting standards mandatory for the NCEs also. So again, when we look at the journey of accounting standards, okay, there are people who are much more experienced than me here, but when I started my career sometime in 98 or 99, we probably had 5 or 6 accounting standards, or maybe about 10 accounting standards. And most of the accounting standards were at the nascent stages. It was more relevant to a measurement perspective rather than a disclosure perspective. And if my memory serves me right, I think it was in 2001 or 2002 that there was a big inflow of accounting standards that got introduced and was made mandatory, which covered lots of disclosure aspects. I think that was the time when I was at least used to disclosures on employee benefits, segment, related party, computation of deferred tax. I still remember even my first listed company wherein I had qualified a non-compliance of deferred tax. So the corporate world has been used to new set of accounting standards being introduced over a period of time. Then we, as an Indian company or an organization, we started becoming global. There has been lots of changes that was happening in global from an accounting standard perspective. So when we went global or global investors came into us, there were differences in the accounting standards between what we were following in India and the global standards like ICAI, IFRS or US GAAP. So there were programs taken by the institute to see how these things can be harmonized, and we had Indias coming in from 2017 onwards. So like that, the accounting standards has been evolving. So after 2017, what happened is we had 2 sets of accounting standards. One which we call as IGAP, lovingly and affectionately, which are applicable for certain class of companies, and for certain class of companies like listed company or net worth more than 250 crores, etc. We have the Ind AS standards. Again, going back to the corporate world, should a company, irrespective of the size, comply with all the accounting standards was the question. So again, there was classifications which was introduced, classifying the companies into 2 broad categories, SMCs and non-SMCs. SMC is small and medium company, and non-SMC, or which are not small and medium company. There were qualitative thresholds and there were quantitative thresholds that were given by the institute. So we go into a company audit, we apply the qualitative thresholds, find out whether that is an SMC or a non-SMC, and then we know what kind of standards would be applicable to a non-SMC and what kind of standards would be applicable to an SMC. There will be some standards which are applicable in full, there are some standards which are not applicable, and there are some standards on which there were exemptions and relaxations given, either from a measurement perspective or from a disclosure perspective. Say for example, segment reporting for non-SMCs, it may not be required. AS 15. For actual valuation of re-encashment and gratuity. If it is going to be a non-SMC, we need to give the complete movement analysis of planned assets, the planned liabilities, the cost, etc. But when it comes to SMC, we just need to disclose the assumptions. So like that, there were relaxations that has been given based on the size and the complexity of the entities. So that's how the relevance of SMC versus non-SMC classification from an accounting standards perspective started helping the corporate world. So as I said, the institute has been issuing certain guidelines in terms of compliance of accounting standards by these NCEs. We had some notification in 2008 which harmonized the differences. In March 2013, these non-corporate entities were classified into levels. At that point of time, I think they had 3 levels, 1, 2 and 3, and the applicability of the accounting standards depended on the level of the NCE. Depending on whether you were in level 1 or level 2 or level 3, you started applying few standards, you started getting exemption on few standards, and on few standards you complied with certain aspects and you had exemption and relaxation with certain aspects. So this has been the journey on how the accounting standards started getting applicable for an NCE from 2013 onwards. So what happened recently? In 2021, there was an ICAI meeting. So this, on 31st March of 21, there was a notification that has been issued on applicability of accounting standards for NCEs. So this notification had classified the NCEs into 4 levels, level 1, level 2, level 3 and level 4. Level 2, 3 and 4 were together called as MSME, which is medium, small and micro enterprises. So the applicability of the accounting standards was determined based on the level of the NCE based on certain criteria. And this though was issued on 31st March of 21, it became applicable from 1st April 20. So from an NCE perspective, this is the recent notification which would guide and determine the applicability of the accounting standards from an NCE perspective. The Institute had also issued a guidance note on this, giving the reference to the various guidelines that I have spoken about, the applicability of the accounting standards and the relaxation and exemptions available. I think it was an exposure draft, and once the guidance note is issued, then there would be a PACA guidance which is available to support the notification on how these accounting standards will be applicable to an NCE. Okay, so I said there were 4 classifications for NCEs, 1, 2, 3 and 4. So now let us look at how the classification is made. So we start with level 1. So what is level 1? So in case if the entity is already listed or is in the process of listing at the end of the relevant financial year, that's condition 1. Or it's a bank or a financial institution or a company or an entity carrying insurance business. Or there are financial parameters. Turnover at any point of the year is more than 250 crores, or borrowings is at any point of the time of the year is more than 50 crores, or if there is an entity which is a holding or subsidiary of any one of these above. So these are the 4 criteria that has been defined to classify an NCE as level 1. So the conditions would be the same for other classifications also, 2, 3 and 4, but the thresholds would differ. So what is level 2? The other conditions will be the same. The turnover has been defined as 50 crores to 250 crores, and the borrowings limit is between 10 crores and 50 crores. So if this is the threshold in which your NCE falls, then you will be classified as level 2, which is called as medium. Small, other conditions remains the same. The turnover is between 10 and 50 and borrowings is between 2 and 10. And if the financial parameters or other conditions are not met, then you get into level 4, which is micro entities. So these are the 4 levels which has been given by the notification which I spoke about, which is applicable from 1st April 2020 on how the NCEs needs to be classified, the qualitative consideration or whether it's listed, what's the kind of business you do, whether it's bank, financial institutions or insurance, whether you have a holding or subsidiary relationship, and the financial parameters comes with reference to the turnover for the financial year or borrowings at any point of the financial year. So you take up an NCE, apply these conditions, and then you will get the level to which that NCE pertains to. Okay, having done and understood which level is, the guidance note also talks about how the various accounting standards will be applicable to an NCE. There are, I think, 29 accounting standards, 1 to 29, with few accounting standards either dropped or it has been combined with other accounting standards. AS 8 is no longer relevant, AS 6 and AS 10 has got combined. So, but from a serial number perspective, we have accounting standards 1 to 29. When I spoke about harmonization of accounting standards and Ind AS, there was also another thing which is happening in the economy today. So, Ind AS, as we all know, would be applicable to certain companies based on the compliance of the financial threshold. And I think 250 crore net worth is one of the important financial consideration. So they follow Ind AS, and if it is less than 250 crores, you still follow the ICAI. But when we see the recent changes that has happened in the accounting standards, even the IGAP standard or the accounting standards under the normal NACAs have undergone a change. And when we look at the changes, these changes are almost similar to what the Ind AS says. I'll give you an example, 2 examples. Proposed dividend. So we always under IGAP used to provide for proposed dividend if it was declared on or before the board meeting of the financial year, which the board meeting, as we all know, happens at the end of the financial year. But we treated under IGAP this to be an adjusting event. But under Ind AS, it is not an adjusting event, and so we just had a disclosure of proposed dividends, though it relates to the financial year under audit. But when we look at accounting standard 4 now, this change has already come in. So irrespective of whether it's an ICAP company or an Ind AS company, you follow the same principles. Look at accounting standard 6 and 10, depreciation. When I studied AS 6, when a company was following say WDV method and they wanted to change into SLM, it was considered as a change in accounting policy, which means that I have to do a retrospective application, and the difference between the carrying value between these two methods will get adjusted on the first day of the financial year. Under Ind AS, either it's a change in method or a change in useful life, it was considered as a change in estimate, which means it is going to be done prospectively. So the recent change of AS 6 combined with AS 10 has brought in this principle. So why I am highlighting this is that though we say it is NACA standard, which is not relevant to certain type of companies based on the threshold, there are modifications coming up even in these standards to make it in line with the Ind AS requirements or the standards which are globally practiced. So that's how. So the harmonization of the accounting standards to make it relevant even to a global audience is a kind of thing which is being felt in the profession based on the initiatives taken by the institute. So why is this relevant in this discussion is that though we start off by saying that for NCEs there are a set of accounting standards which are relevant, it is the same set of accounting standards as given by NACAs which we need to apply for NCEs also. If it is AS2, whether it is an NCE or a corporate, it's the same principles. But what is the difference? Depending on the level of NCE 1, 2, 3 or 4, there may be certain relaxations which is already inbuilt into the standard. So this part of the discussion that I am going to do is to talk about these accounting standards, how is it applicable to an NCE, and for certain standards, what are the relaxations which are available to NCE as compared to a non-NCE. So this is the background of the next few slides. Again, as I said, since it's a 3-day program, I will touch upon those differences which are not covered in this 3-day program slightly in detail. So for example, if you are going to talk on AS 19 leases tomorrow or day after, I am not going to spend too much of time in talking about the relaxations because the learned speaker on that day will again talk about those things. So my discussion would be in terms of applicability and relaxations of these accounting standards will be confined to my 3 topics, which is 1, 2 and 7. And I will also touch upon the relaxations on other standards which is not covered in the 3-day session. Okay, going back to the first bullet, level 1, all the accounting standards are applicable in full, no relaxations. So it's straightforward, it does not make a difference whether it's for an NCE or a non-SMC. So the next category is these accounting standards would be applicable in its entirety to all the 3 levels, 2, 3 and 4. So because again when I talk about relaxation, since I have already carved out level 1, stating that all accounting standards are applicable and there is no relaxation, when we discuss on relaxations, we will be touching upon what is the relaxation and to which level of NCEs is the relaxation applicable. So there are no relaxations when it comes to these standards, which is 1, 2, 4, 5, 7, 9, 12 and 16. So level 1, level 2, level 3, level 4, all the 4 classifications of NCEs, when it comes to these standards, they will have to ensure compliance in full without any relaxation. So when I deal with 1, 2 and 7, I need not talk about what is the relaxation which is available to NCE because the standard is applicable in full irrespective of the level of NCE. Okay. The next carve out is AS3, which is on cash flow, AS17 on segment reporting and AS20 on EPS is not applicable to any of the NCEs. So straightforward. So few standards are applicable in its entirety, so there is no confusion. Few standards, straight away it's not applicable to any level, so it's straightforward. Few standards, which is basically on consolidation of subsidiaries or consolidation of joint ventures or consolidation of associates or interim financial reporting. Generally, the conception is that NCEs may not have subsidiaries or associates, and so you don't need to end up in doing these standards. But when we look at the guidance note, it says that in case if any of the NCEs falls under the situation of doing a consolidation, either of a joint venture or a subsidiary, then you follow the principles given in 21, 23 or 27. So again, not much of complications. So this is the main slide when it comes to relaxations. What we are going to discuss here is certain standards and what are the relaxations available on those standards and to which level those relaxations will be applicable. So we'll start with AS 10 and 11. In AS 10 and 11, for level 2 it's applicable in full. For level 3 and 4, there are certain disclosure exemptions. So what are those disclosure exemptions? We will talk about in the coming slides. When it comes to AS 13, 14, 22 and 26, it is applicable for level 2 and 3. For level 4, there are disclosure exemptions. AS 22, as we know, it talks about current tax and deferred tax. When it comes to level 4, you take only the principles of current tax, because for level 4, you don't need to compute deferred tax. So that's a straightforward exemption. And AS 14, as I told, only if there are transactions we need to apply with. AS 18 and 24, it's applicable only to level 2. So level 3 and level 4, there is a complete exemption for disclosure of related party transactions and discontinued operations. When it comes to 15, 19 and 29, there are disclosure exemptions given to all the three levels. So we will talk in detail about what are those disclosure exemptions. Again, when it comes to AS 28, it is applicable to level 2 and 3 with disclosure exemptions, and it is not applicable to level 4. So don't get confused. These things are there very clear in the guidance note. And when I was preparing for this session, I also noted a FAQ given by WARC. There is a link, I can forward the link to the SIRC who can share it with you. And that FAQ was giving specific questions and answers which would probably clarify most of the doubts that we have got. Those questions which I felt was very important and relevant, I'm going to cover as part of this discussion. But these two materials, the WARC FAQs and the Institute Guidance Note, would give a complete clarity in terms of what I have discussed till now. See, as I said, it is the same set of standards which has been issued by NACAS. So when you look at the standard, this is how the wordings are looking at. See, as I said, AS 11, there would be some exemptions. So paragraph 44 is one of the exemptions. So what is paragraph 44? Disclosure is also encouraged of an enterprise foreign currency risk management policy. So that is there in the standard. When you see the accounting standard which is there in the ICAI website now, it also says provided that the MSME level 3 and 4 as defined in appendix 1 to the compendium may not comply with paragraph 44. So it's very clear that for level 3 and 4 of NSCs, this requirement of 44 is not required. So the accounting standards have been formulated in this manner. You go into the standard, you will understand what that particular paragraph is, and then below that paragraph, you will find out this paragraph which will provide exemptions to NSC based on the classification. When I say appendix 1, this appendix 1 is nothing but the circular that I have spoken about and gives a summary of the accounting standards which are applicable to various levels. Again, it's there in the resources under ICAI website. So it's very easy for us to navigate the accounting standards. Once you classify your NCE in terms of the level, it will be very easy for you to navigate the accounting standards and understand which paragraph is required to be complied by you and for which paragraph there is an exemption available. So this would be, again, as I said, very important only in those standards where there are certain exemptions. Fully applicable and fully not applicable will be a straightforward case. So as I said, I will be discussing some exemptions which is given in AS 13, 15, 22, 26, 28 and 29. But other standards, as I said, since it's going to be discussed by other speakers, I may not dwell in much detail. So if I have to just summarize this first 20-25 minutes discussion, we understood what is NCE, we understood what are the types of non-corporate entities, we understood the ICAI notification which became applicable from 1st April 20. We understood that the NCEs can be classified into 4 levels, 1, 2, 3 and 4. We understood the manner in which you will determine based on the thresholds, which is either a qualitative threshold of nature of business or holding subsidiary relationship or listed or not, or the quantitative threshold in terms of turnover or borrowings. Then we had an understanding in terms of how for level 1 NCEs all the accounting standards would be applicable, how certain accounting standards are not applicable to any of the levels, and how certain accounting standards are applicable only to certain levels, or there are relaxation and exemptions given to other levels in terms of complying with those accounting standards. So this is the broad summary of what we have covered till now. So now if we look at a slightly more detail, let us understand what are some of the relaxations or exemptions which are given. Again, I am not going to spend time on the 100% of relaxations, but let me throw out one or two relaxations which is given in the standards for us to get a feel of it. So let us take AS10. AS10 says, paragraph 87, which is an encouraged disclosure, there is an exemption for levels 3 and 4. So what are those disclosures under AS10 which is exempt for level 3 and 4? If there are any idle assets, we don't need to disclose the carrying value. If there is any asset which is fully depreciated but still in use, we don't need to disclose. If there is any revaluation of fixed assets, we don't need to disclose what is the equivalent cost of those assets if I had not revalued. And I don't need to disclose the carrying value of the assets which are retired but which I have not held for disposal. So it's very simple. Go to the standard, go to AS10, look at paragraph 87. 87 will say disclose these things. But below paragraph 87, it will say these disclosures are not relevant for level 3 and 4 of NCE as detailed in appendix 1. So it's, as I said, I showed you an example. It's very easy for us to understand whether that particular disclosure is relevant to the NCE or not based on the classification. Now let us look at an example of AS11, paragraph 44. What is the disclosure requirement of paragraph 44? Foreign currency risk management policy. It says level 3 and 4 need not disclose this. So that's the example I showed here. This is just the cut and paste from the standard. It's very clear to state that what is the requirement, and the below paragraph says it need not be complied with by level 3 and 4. So, accounting standard 13, which is on investments, there are specific disclosure requirements by relevant government statute under paragraph 35, but level 4 entities need not disclose that. Employee benefits is slightly tricky because there are two conditions which are given when it comes to employee benefits. The first condition is classify the level, whether it's 2, 3 or 4. The second condition is also look at the number of employees, because the classification is given for those entities which has more than 50 employees and for those employees which has less than 50 employees. So when you go into an NCE, you need to have a feel of the headcount of that, because if it is less than 50 or more than 50 would have a direct impact on how we value employee benefits. We all know AS15, what does it talk about? It talks about employee benefits, salaries, wages, PF, ESI, leave encashment, gratuity, bonus, anything on that. The typical way where there could be differences would come to valuation of gratuity and leave encashment. Again, we all will be used to do an actuarial valuation because it's a kind of a long-term compensation. And the standard specifically states that we should use the projected unit credit method for actuarial valuation. So, what does the exemption talk about? If it says the number of employees is less than 50 people, you don't need to do an actuarial valuation. So, you can do a valuation of employment benefits like gratuity and leave encashment in a manner which would provide a reasonable estimate of the future possible liability. So, when you look at a listed company under even IGAP or Ind AS, there would be lots of disclosures which is required under AS15. Say for example, the plant value of the assets, the movement, the plant value of the liabilities movement, the cost of P&L, the assumptions, etc. So though there are lots of paragraphs referred here, in nutshell, the crux is that most of these disclosure requirements will not be required for level 3 and level 4 NCEs, because level 3 and level 4 you don't even do an actuarial valuation, and when it comes to level 2 with more than 50 employees, you do an actuarial valuation and you disclose only the assumptions that is used in actuarial valuation. And what are the typical assumptions that we disclose? We give the attrition rate, we give the increment rate, we give the discount rate. So do the valuation, get an actuary to do it, get it signed, see the assumptions, validate the assumptions, and disclose if it is more than 50 employees. If it is less than 50 employees, most of the times we just do a full cost valuation, which is nothing but 15 by 26 of the final CTC multiplied by completed number of years of service. So, from the exemptions perspective, AS 15 could be slightly trickier because you need to know and understand the combination of the number of employees and the level to which the entity pertains to. So AS 19, as I said, it will be dealt with it in detail in the next session. Accounting for income taxes, as I said, level 4, there is no requirement of having deferred tax. So the standard of AS 22, only to the extent it pertains to current tax, will be applicable for level 4 entities. So what happens if there is a change in level? So I will talk about change in level as one of my slides, because it is not that you are going to remain in a particular level lifelong. So you may become level 3 or level 2 or level 1 from level 4, or even a level 1 company can become 2, 3 or 4. So how does the impact of this change in level affect the compliance of accounting standards? I have a slide and I will discuss about it. Again, intangible assets, there are exemptions for level 4, which would be basically the movement of intangible assets from opening balance to closing balance, and also to disclose about the intangible assets which are fully amortized but still in use. The second paragraph 98 is very similar to the exemption that we saw in AS 10. So provision and contingencies, for example, we under a level 1 entity, we try to give a movement of the provision. Say for example, you have provision for warranties. So there is a disclosure requirement which will say you have to give what is the opening provision, how much of additional provision of warranty you made during the year, how much of settlement you made on warranty claims, how much of warranty provision you felt is no longer required, and you write it back and you give the closing balance. So this kind of movement of the provision for warranty or any other provision is a mandatory requirement of AS 29. But when it comes to level 2, 3 and 4, this movement may not be required. So you comply with the accounting standard 29 from a measurement perspective, but when it comes to disclosure, since you are not a level 1 NCE, you don't need to disclose. So this is in summary about certain relaxations. If I have to summarize, there are certain standards, about 15 standards, wherein you may need to comply with the standard from a measurement perspective, but when it comes to disclosures perspective, depending on the level, whether it's level 2, level 3 or level 4, there are certain disclosures which are available and applicable, and there are certain disclosures for which you have an exemption. So you go into the entity, classify it, understand the requirements, see whether there is a relaxation, and then you take a call. Okay, when you speak about relaxations, you will not be able to pick and choose the relaxations available. Say for example, if there is AS 10 and there are 5 relaxations available, you have to ensure that you have a relaxation taken for the entire disclosure of AS 10. You can't say, I will make a disclosure of 3 and I will take exemption under the standard for 2 other relaxations. That's not possible, because the purpose of doing these disclosures is to ensure that the readers of the financial statements get a clarity in terms of what you have done. So if you pick and choose, then the readers may not be able to get the full picture. So if you take a relaxation, then you take the relaxation for the entire standard. But in case if you voluntarily want to do certain disclosures, though there is a relaxation available to you as per the standard, good enough, you can do it. Say for example, if I take the example of warranty, if you still want to give the moment of warranty, though there is an exemption, you can go ahead and do it. So the ulta is possible. You can, in the financial statements, take disclosures of those standards even if there is a relaxation, but you can't very pick and say, I will take 2 of the disclosures and get relaxation for the balance sheet. So this is something very important that you need to have a look at it on a practical aspect. The guidance note also gives you the format of the financial statements and the format of the audit report. So you are free to look at the guidance note and ensure that you comply with the requirements. Say Schedule 3, there is a format given by Companies Act. So like that, this guidance note for NCEs gives you the format of the financial statements which needs to be adopted by NCEs. Applicability for charitable and religious. When I started the discussion, I said NCEs would be something where the accounting standards would be relevant if they carry out some business or profession. If there is no business or profession, then the compliance of accounting standards need not be required. But if there is a trust or a society where some part is relevant to your business or profession and some part is not relevant to your business or profession, then you come under the compliance requirement, and for the entire business you of the trust, you need to disclose the requirements of the standard. You just can't say that I will do the disclosure only for that part of my business which is a relatable business or profession, and I won't do it for other. Even if there is some amount of business or profession carried by the organization, then the requirements of these accounting standards kicks in. Tax audit, as you all know under Form 3CD, we need to see and comment whether the accounting method which is employed by the assessee to compute the profit or loss is correct and acceptable. So when we do the audits of NCEs, the accounting methodology here would be driven by the accounting standards. So even when you do the tax audit, it is very relevant for you to ensure compliances before you can comment on clause 11D of the standards. As I said, levels 2, 3 and 4 are together called as an MSME. So the financial statement should have a disclosure stating that we are an MSME, and so accordingly the disclosures has been made only to the extent as relevant to be. So this will be an affirmative statement that you should have in the financial statements as per the guidance note. Cash accounting or accrual basis, generally accrual, but there are certain professions which can use cash. So just because you use cash, the auditor cannot go and qualify the accounts, because even as per the standards for that kind of business, a cash accounting methodology is allowed. The only thing is that you need to ensure consistency. Foreign currency exposure and derivatives, this is an important disclosure. So if you have foreign currency outstanding balances at year end, which is unhedged, there needs to be a disclosure, and this disclosure would be applicable to all the levels of NCEs. UDIN, if you certify something even for an NCE, then you need to create UDIN. And depreciation, you are allowed. One second, I'll just complete this slide and take the question. Depreciation, again, you can either follow the Companies Act, or you can follow the technical estimate, or you can follow the Income Tax Act for the books. But when it comes to income tax, you need to follow the principles given in the income tax. So again, as I said, there were certain FAQs which was available, and these were some FAQs which I felt was relevant. This is mainly in terms of the format of the financial statements, disclosure as MSME, cash basis versus accrual basis, the tax audit requirement of ensuring compliance with accounting standards, depreciation and disclosure of unhedged foreign currencies. Yes sir, please go ahead. Sorry, I'm not able to get to you. Any accounting standard which is applicable for?
To NGOs, non-government organizations, NGOs, trusts.
Yeah, NGOs or trusts will be covered under NCEs. So we just need to ascertain whether they are carrying out a business.
For example, if they don't have any business activities at all.
It may not be required, because the first condition that we need to check is whether they carry out any business or profession. If it is just going to be done only for charitable purposes, then it even does not get kicked in into the definition of NCEs. And as I said, the last slide is the change in levels. We will see how it happens when it becomes an upgrade or when it happens a downgrade. If it becomes an upgrade, meaning 4 becomes 3 or 3 becomes 2, then in the relevant financial year in which you had the upgrade, for that financial year, you need to ensure compliance of all the accounting standards which is relevant to that level. But the previous year financial statements would have been done at the old level. So you don't need to go and restate the prior year comparatives in line with the current level classification. But you need to have a disclosure stating that I was level 2 last year, I became level 1 this year. So I started applying the accounting principles as applicable to level 1 only in the current year, and I have not restated prior year comparatives. So now what happens when it becomes a downgrade? Level 1 becomes level 2 or level 2 becomes level 3. Then whatever level you were earlier and whatever compliances you had earlier, you need to ensure continuance of those compliances for 2 more years. So it is just not that you walk out stating that I have become level 2 and I won't do the accounting standards compliance now. For 2 more years, you need to ensure compliances of the higher level, and then you can start doing the compliances applicable to the present level. And this is something which is very similar even in corporates for SMC to non-SMC. So even if you are in non-SMC and you become an SMC, because last year the definition of SMC got changed and the thresholds had increased, you will still continue to disclose the requirements as if you are a non-SMC for 2 more years. And the same principle has been included for NCEs also. So this is a very quick background of NCE. So we understood what is NCE, the definition, the ICAI notification, the classification, the manner in which you do the classification, the applicability of accounting standards, the relaxations for accounting standards compliance based on the levels. We had certain few aspects discussed, and we also discussed how you ensure compliance if there is a change in level. So if there are any specific questions on NCE, I'll be happy to take it now. Before
What happens if there's a conversion from NCE to a corporate entity? It is upgrade or downgrade?
It would be an upgrade probably, not directly dealt with by the accounting standard, but it would be probably a upgrade. Yeah, I'm not sure how it practically happens, but a trust getting converted into a company, but partnership can get converted into a company under Part 9. Yeah, so probably it will be an upgrade, and you start looking at the company to see whether it's an SMC or not SMC, and then depending on that classification, you probably need to do a compliance with necessary relevant disclosures. Yeah, Part 9 could be happening. Okay, so this is on NCEs, so I thought we'll start the discussion by having some discussions on NCEs before we get into the actual standards. Okay, so we are required to cover 3 standards, 1, 2 and 7. As we looked at the applicability of accounting standards, 1, 2 and 7 is applicable to all levels. So when I discuss this, it will be relevant to levels 1, 2, 3 and 4. So I may not talk anything about the exemptions which is available to any of the levels. And again, as professionals, we have dealt with these accounting standards lots of time. So we'll just go through the concepts, but it would be good if you can bring out any practical challenges that you face in implementing these accounting standards, because that would make the discussion more meaningful rather than I running through the standards, because as I said, these standards have been in vogue from at least 98 or 99, and everybody have been used to it. So let us start looking at some of the key principles. Wherever if I had faced some challenges in my profession, I will touch upon it, but would encourage you people to let me know the challenges in compliance, because that would help the professionals here. So AS1, disclosure of accounting policies, started in 2006. This standard talks about the significant accounting policies that needs to be followed in presenting the financial statements. And as I said, this is mandatory for all the companies. When I say disclosure of accounting policies, it is very important because there are accounting policy choices which is applicable, which is available to the users. So the readers of the financial statements should understand what kind of accounting policy choices that you have made. Unless that is getting disclosed, you will not be able to understand and appreciate the numbers. Say for example, depreciation. If you just give a table stating that my cost is 100 and my depreciation is 5, it makes very less sense, because people will not know what is the method of depreciation that you have followed, what is the basis. So they will not be able to project how long it will take to depreciate. Why is this confusion coming? Because when you look at the standard, there are multiple ways of providing depreciation. You can follow WDV method, you can follow straight line method, you can follow the estimated technical life as determined by the management. So since there are multiple choices available, it becomes very important to disclose the policy choice in the financial statements, so that the readers of the financial statement would be able to understand and appreciate the number and link what you have stated in the accounting policy to the actual disclosure in the financial statements. So as we all know, again, there are three fundamental assumptions when it comes to preparation of the financial statements: going concern, consistency, and accrual basis. If you don't follow any of these principles, then there needs to be a disclosure in the financial statements. Okay, we have seen companies disclose stating that we are not a going concern, and hence all the assets and liabilities are being reflected at the carrying value, and all the assets and liabilities have been disclosed as current and not non-current. And why am I not a going concern? You may say, I'm shutting down business, or I am closing the branch, or I am closing the license office, etc. So going concern would be one of the important aspects where practically I have seen a specific disclosure being coming in if the financials are not prepared on a going concern basis. So they describe why it is not a going concern and what are the consequences of not preparing the financials on a going concern basis. Consistency: the accounting policies and principles that you have followed should be consistently followed. So again, there is no mandatory requirement to say that I am consistent, but when you are not consistent, you need to have a disclosure. So I'll come to my last slide. Going back to my example of depreciation. If I had followed WDV method till last year and I moved to SLM method this year, it is not relevant to the present day standard. I just it's an old example. Then I need to disclose stating that I was following WDV till last year. I changed to SLM in the current year. I did a retrospective change, and because of this retrospective change, the carrying value of the assets have increased by this much, or increased or decreased, and the reserves have increased or decreased by this much. Not a relevant example as AS 10 stands today. What would be a relevant example today? Say, for example, you had a plant and machinery for which you had a life of 10 years estimated till last year. But now we have changed the life to 7 years. Again, you are not consistent. So you need to disclose stating that I have changed the estimated life from 10 years to 7 years because of so and so. So because of this, the depreciation charge for the current year has been increased by so and so rupees. So if you are not consistent, then you need to disclose what change you have made, probably why of it, and the financial impact of that change, either for the current year or the expected impact of that particular change on the financials that would come in the for coming years. So this is the example in terms of consistency. Accrual basis, we have seen lots of accounting policies which will say I prepared the accounts on an accrual basis, which is straightforward. So these are the fundamental assumptions, and there would be a disclosure requirement if any of these assumptions are not being followed. So as I said, we can take examples from each of the standard on the various choices which are available to you, which makes the disclosure of those policies very important. Take the example of inventories. We have FIFO, we have weighted average, we have specific identified method. So just inventories 10 crores does not give any impetus to the reader. But if you can say, I have been valuing inventories on a FIFO basis, and the basis that I have followed is cost or NRV, whichever is lower, it makes much better sense for us to understand the inventory value rather than just seeing a number of 10 crores. So since there are accounting policy choices or an estimate choices which are available in the standard, the disclosure of accounting policies becomes very relevant and very important. There are certain fundamental criteria that is to be followed by the assessees or the companies in selecting the accounting policies. So there are three considerations which is very important: prudence, substance over form, and materiality. So prudent, we chartered accountants, we always like to be prudent. So we are always conservative, or we need to be conservative. So you recognize income only it is more or less certain that you will recognize or receive it. But when it comes to cost or expenses, you provide even when you have the slightest doubt that you may need to incur. Yes, you may have some estimates in terms of how you determine the cost, but that is how we generally do the accounting. Revenue you try to postpone, but expenses we try to do it at the earliest. Substance over form, again a very typical statement that we as a professional here. We just don't go only with the legal form, we look at the substance of the transaction which will determine the accounting to be done. Materiality, very important, because even the preface to the accounting standards talks about materiality, and we need to make those disclosures which are material to the overall financial statements. Again, when you look at the recent happenings under Ind AS requirements in, I think, the first standard of Ind AS, there has been a change which has come in the current year, which says you need to only disclose those material accounting standards. It is no longer significant accounting policies. It has now been changed to material accounting policies. So, for example, if you have export incentives, and the total amount of export incentives that you earn in a year is not very material according to the management, then you need not have the disclosure of accounting policies with reference to how you recognize the export incentives into the financial statements. So this has got changed in the accounting, Indian accounting standards, Ind AS, but even when you look at the preface, this would be applicable only based on the materiality. So these are the considerations that you will consider, you meaning the clients would consider in determining the accounting policies. Just because you disclose something, even if that something is going to be done wrongly by you, it does not help you. Say, for example, you do LIFO method of inventory valuation and you say, I have disclosed it. It does not make it correct because AS2 says you cannot value inventory on LIFO. So just by disclosing, you don't get pardon. So you need to follow those things which are available in the standard and then do the disclosures. One of the preferred method of doing the disclosure is to ensure all the accounting policies are disclosed at one point of time continuously. So when you see a typical financial statement, you will have balance sheet, P&L, cash flow. Then you will have the first note which talks about the background, and the second note generally talks about the accounting policies. And generally the structure which is being followed is you go in the sequence of the accounting standards. You talk about fundamental assumption, then you talk about inventories, then you talk about revenue recognition, then you talk about depreciation. Just a practice. I'm not saying that this is the only method in which you need to disclose, but the preferable method is to ensure you disclose everything at a point which is consistent and it is easily available to the reader, rather than he having required to search the document and understand where the policy is. Having said that, I have also seen big listed companies who disclose the accounting policy based on the notes. Say, for example, you won't have a section called significant accounting policies. If you have employee benefits as the disclosure under Ind AS 19 or AS 15, the accounting policy on how you measure employee benefits will be included under that section. So it is not wrong, but when you look at the standard, the preferred methodology is to ensure that you disclose everything at a single place so that it helps the reader to understand the policies that has been followed. So we already discussed about the change in accounting policies. It's a very simple standard, 3 fundamental assumptions which needs to be complied with: going concern, consistency and approval, and disclosure would be made if these fundamental assumptions are not there. It's applicable to material aspects. It is very important because of the choices which is available to the clients. Apply the principle of prudence, substance over form and materiality, and ensure that you have an adequate disclosure so that the readers of the financial statements would be able to appreciate the numbers and link the numbers to what you have done as a methodology of getting those numbers. And if there is any changes in the accounting policy which would have an impact either in the current year or in the coming years, you need to have a separate disclosure stating what has changed and why it has changed, and what is the financial impact or what would be the expected financial impact because of that change. Any questions, any practical challenges? Okay, the next standard is AS2, inventories. So we will again touch upon aspects like the overview of the standard, the objective of the standard, the applicability, certain key terms, certain key concepts, and the disclosure requirements given in the standard. Again, this is a standard which is applicable to all the 4 levels of NCEs. Introduced in 1981, some changes were made into the standard in March 2002, and this standard is mandatory in nature. So what is inventories? It can be raw materials, that is the materials or supplies which are used in the process of production. It can be work in progress, which is in progress. On completion, it will be available for a sale. or it can be finished goods which are available for sale, but you have not sold it at the year end. So this standard, what is it trying to do is to bring in a matching concept. You are a manufacturing company, you try to manufacture products and then sell and get the revenue. So for those process of manufacturing, you need materials. So it talks about how to value those materials. There may be certain things which is in progress, so you have to value the work in progress. And there could be items which are completed but not sold. So how to value the finished goods? Because then if you defer the cost, there could be a matching concept. You recognize the revenue and you recognize the mapping cost related to that revenue. AS2 is not applicable to work in progress under construction contracts, which is under AS7. So we will talk about how a work in progress is valued and AS7 scenario in the next session. Shares, debentures, financial instruments held in stock in trade, it is not applicable. And if there is any livestock or agricultural or forest products, then AS2 does not talk about how these things needs to be valued. So what are inventories? These are assets which are held in the ordinary course of business in the process of production, and it can be in terms of materials or supplies which helps production or helps rendering of services. So how do you value it? Conservative, cost or net realizable value, whichever is less. What is net realizable value? How much you can earn in selling those inventories less the cost of sale plus the cost of completion. For example, if it is WIP, you may also need to incur some additional cost to convert the WIP into FG, incur certain cost to sell it. So back out these two things and then arrive at the net realizable value. So what is cost? It includes the cost of purchase, the cost of conversion, and other costs. If I look at the standard, it says incurred in bringing the inventories to their present location and condition. So this sentence is very important because that will determine the kind of cost that you incur and which can be attributed towards the inventory value. It does not include foreign exchange fluctuation because foreign exchange fluctuation is considered more as a settlement of a liability rather than the cost incurred for production. And if there are costs which are incurred but which does not fit into this line of bringing the inventories to their present location and condition, then you can't inventorize it. So cost of purchase would include purchase cost, import duties, taxes if it is not recoverable. If it is GST where you can either offset it or claim a refund, then the GST cost cannot be included as part of inventories. Transport and handling charges and trade discounts and rebates. If you have purchase discounts or trade discounts which is available, then to that extent you reduce the cost because it has already been compensated. Cost of conversion would include your direct labor cost. It will have some fixed and variable overheads. And other costs, as I said, only if it is incurred to bring the inventories to the present location, you need to inventorize it. Allocation of overheads, it can be fixed overheads or it can be variable overheads. So fixed overheads, you do the absorption. Variable overheads, you determine it based on the units of production. Again, conservatism comes into picture. You cannot absorb overheads in excess because of your idle capacity or you not being able to utilize your facility in the fullest possible manner. So you take the normal capacity, and if there is any idle capacity, then you may need to charge off those overheads, and we cannot inventorize it. Again, the process of conservatism comes into picture. What is excluded from cost of inventory? Any abnormal material wastage. Normal loss can be included, abnormal loss cannot be included. There are costs which is relating to selling or marketing, then that cannot be inventorized. Storage cost, you only inventorize if it actually helps you to bring the inventory to the present location or condition, otherwise storage cost should also get excluded. And administrative overheads and selling and distribution cost can never be part of the inventory cost. Joint products and byproducts, there could be, based on your production, certain joint products which are coming in or certain byproducts that are coming in. The standard also talks about how do you value the joint product and how do you value the byproduct. So joint product are generally done based on the realizable value because it may be difficult to split the cost of joint product and the main product as production happens. Byproduct, generally it is not going to be material, so you value it at NRV, but you reduce that NRV from the main product's cost. So service provider like professionals like us, probably the labor cost and the rentals would be some cost which are directly attributable to the services that we do. Again, as I said, this is a standard which have been there for at least 40 years, and each one of us will have done thousands of inventory valuations. So that's why I'm just trying to touch upon the key concepts rather than having a very detailed discussion. Cost formula, it can be FIFO, it can be weighted average, it can be specific identified method, or it can be even standard cost. So you determine based on the kind of inventory and the nature of inventory, the nature of business, what would be the best way to value your inventories. Again, based on the category of the items, you may be allowed to value two different methodologies of inventories. But again, you need to be consistent. So once you determine a methodology, it's preferable to use the same method going forward, because changing in from weighted average to FIFO or FIFO to weighted average would be very difficult even from a practical aspect. So standard cost, we fix up the standard at the year beginning, use that standard cost for the valuation through the period. We need to ensure that the standard is revised at frequent or reasonable interval, and at the year end you compute the actuals for the standard, and you need to do an under or over absorption of inventories, because under or over absorption of the overheads, because again you cannot carry cost into the balance sheet if it is not recoverable. So this is one of the policy statement that I have seen. It says, as I said, gold it is done on FIFO basis, silver it is done on weighted average basis, and for studded jewelry it is based on specific identified basis. So depending on the nature of the item, you can determine the you can determine the valuation methodology. It's not that if you have chosen FIFO, all the raw materials or all the products should be done under a FIFO method. So there are three classifications here, and for each of the classification, the company had adopted a different method of valuation, which is allowed and acceptable as per AS2. Net realizable value, we saw the definition. It is, we need to value at NRV because of the consideration of prudence. You cannot carry inventory at a value which is more than what you can realize. There are 2-3 things which we generally do practically. One, when it comes to finished goods, we know the cost of finished goods. When you do the audit after the year end, you will know the average rates at which those goods have been actually sold. So you compare the value at which it was sold to the value at which it is carried, and if the sale value is lower, then you have to mark it to the NRV, because you know for sure that you are not realizing the cost. So for FG, we always try to do a subsequent sales analysis to understand what would be the valuation it needs to be done. Similarly, this cost or NRV methodology is also applicable to raw materials. So for example, if you have a product and based on the analysis you find out that there is a gross loss in selling of that product. So the moment it comes to gross loss, you see the sale price, and for that sale price you will know what is the raw materials that went into production. So you need to ensure that you are at least able to recover the cost of raw materials, though you make a gross loss on actual sales. If you are able to recover the raw material cost, then fine, the raw materials can still be valued at cost. If because of the market conditions and the prevailing sale prices, you are not even able to recover the raw material cost, even the raw material value needs to be brought down. So this is something practically which I have seen in certain cases not being tested. So in a loss-making scenario, or in a situation where there is a gross loss in the sale of products, we need to make this test to see whether A, you are able to recover the cost of raw materials, and B, if you are not able to recover the cost of raw materials, you need to write down the value of raw materials. This is there in the standard, but practically this is something which we need to ensure we don't miss out. And disclosures as required by AS1 for inventories would include how you value the inventories, what methodology you follow, what is the total carrying value of inventories, if there is any write down of inventories, what is the kind of write down, and when you see the balance sheet, you also see the valuation for each category, like what is my value of raw materials, finished goods, work in progress, tools, others. So this is a simple standard, as I said again, in terms of AS2 inventories. It talks about how the valuation needs to be done. The broad principle is cost or NRV, whichever is lower. It gives you the definition of what is cost. It has to be only directly attributable cost to bring the inventory to the present location and condition. So we understood what could be the direct cost which are generally attributable. We also touched upon absorption of overheads. We discussed about the various methodology based on which the valuation can be done, FIFO, weighted average, specific identification. We spoke about how an NRV testing is going to be done, and we discussed about what are the disclosure requirements as per the standard when it comes to AS2 requirements. So the last part of today's evening discussion will be on AS7, which is on construction contracts. So again, standard which has been in vogue for a very long time. Again, from an examination perspective, I have faced nightmares in understanding the standard and implementing it because of certain complexities there in the standard in terms of how to measure the cost and how to measure the revenue. Why is the standard important is again mostly to bring in the concept of matching. Because when we see the word construction, we all understand that it is something which is going to take time to complete. Say construction of bridges or dams or aircraft or ships, etc. So it could spill over financial years. So there could be costs which are incurred in the current year, but the actual construction can happen only at the end of the next year. So generally we take a cutoff of more than 12 months. So what should happen to the cost that has been incurred by me in the current year? So how do I defer? Okay, so if something, say a thermal power plant, it takes long time to construct, how do I revisit the cost at the end of each of the financial years? I could, based on my billing terms with my customer, will be able to bill them and collect money on a periodic basis, because it's just not possible for me to invest the entire money in year one and wait for my inflows to happen after 5 years. So I may have a periodic billing and collection. Billing and collection is always different from revenue recognition. So under this construction contract, which takes long time, how would I recognize revenue at the end of each of the financial years? So these would be certain concepts which are being dealt with in IAS 7. So it prescribes the accounting treatment of revenue and the related costs associated with the construction contracts, because the date at which the contract activity is entered into and the date in which the activity gets completed falls in two different accounting periods. So what is the construction contract? It is a contract specifically negotiated for construction of an asset or a combination of assets that are closely interrelated or interdependent in terms of design, technology, function, or their ultimate purpose and use. Generally, the contracts will be of two types. It can be a fixed price contract or it can be a cost plus contract. So what is a fixed price contract? On day number 1, I negotiate and then say I get only this much for doing this project. Cost plus, it is always the actual cost that I incur plus the acceptable markup. So these will be the two general method based on which the cost is getting, or the sale price is getting recognized in a AS7 environment. So fixed price is the construction contract in which the contractor agrees to a fixed contract price or a fixed rate per output. And if it is cost plus, it is I will be able to recover all my costs. So this is the way in which you have the contract, enter into a fixed price contract or a cost plus contract. Then you undergo the construction activities. I will incur costs. So how do you accumulate cost is something which is very important, because Again, the principles of AS2 will come into principle. So you need to accumulate only those costs which are directly attributable to the construction. If it is not directly attributable, then those will get charged off as P&L cost. So how do I recognize revenue? Because as I said, it spills over multiple years. So the revenue can be recognized in two methodologies. Mainly we follow a percentage of completion method or a completed contract method. A completed contract method is straightforward because I recognize revenue only on completion. When it comes to percentage of completion, as the terminology suggests, I will be able to recognize revenue as and when I complete the work at the end of each financial year. So how do I now compute the percentage of completion? So again, the standard provides 2 or 3 methods based on which you can compute the percentage of completion. It can be based on surveys, which would be what is the actual work that I have done. So for that actual work, what is my cost? What is the proportionate revenue? I can recognize it. But the general methodology that is being used under AS7 that I have seen is proportion of cost to the total estimated cost. So very simple, when I have to put some max, if for example, you have a contract for 10 crores, you estimate that you will incur 9 crores of cost with a 1 crore profit margin. So which is a profit margin of 10%. So at the end of the year, say for example, you have incurred 3 crores of cost. So the percentage of completion is done by 3 by 9, which is the actual cost to the projected cost, which is 1/3. So when your expected revenue on completion is 10 crores, you recognize 1/3 of 10 crores, which is 3.3 crores as the revenue. So very simple to explain in a stage, but very difficult to practically implement it because there are lots of variables. But when it comes to percentage of completion method, this is the simplest formula that is being suggested by the standard. Go with the proportion of cost to the estimated total cost, determine the percentage and apply that percentage on your revenue and recognize revenue. Okay, the complications would be 10 crores can be a fixed price contract, there is no change. But this 9 crores of estimated cost is something that you estimate on day number 1. And as I said, the construction contracts can happen over a 2 to 3 year period. So there are going to be differences in estimate. There are going to be cost escalations. So which means what you estimated at 9 crores on day number 1 can be more or can be less as the contract progresses. So you need to re-estimate this total cost to be incurred on a periodic basis. So that's how we come into AS29, wherein this cost or estimate cannot be stagnant. You need to re-estimate it at every period end. So when it comes to a re-estimation, then at the end of the second period, you would compute the percentage based on the re-estimated cost. Say for example, in my example, if 9 crores, if this 9 crores becomes 9.5 crores at the end of the second year based on my estimate, and having spent 3 crores in the first year, if I spent another say 1.75 crores in the second year, so the total cost that I've incurred at the end of the second year is 4.75 crores. And my current estimate is 9.5 crores. So I mean to say that now I have completed 50%. So 50% of 10 crores is 5 crores. And I have already recognized 3.3 crores in the first year. So I need to recognize 1.7 crores in the second year. So this change in estimate is something which has happened due to the circumstances which happened in the current year. So there is no question of prior period item or a prior period error in this concept. I cannot say, no, I should have done it at 9.5 crores last year. So 3 out of 9.5 is say 30%. I have recognized 33%. So is 3% an error or a 3% a prior period item? The answer is no. Because that is how this industry is. So the standard says that you re-estimate the cost periodically, you apply the percentage based on the re-estimated cost and the actual cost incurred at every period end, determine the percentage, determine the life to date revenue to be recognized, back off the revenue which has already been recognized till the end of the previous year, and recognize the balance in the current year. Okay, straightforward. Now, when I spoke about AS2, I said contract work in progress. Under AS7 is exempt under AS2. So what would happen here in this circumstances? See, as I told you again at the beginning of AS7 discussion, you may have a separate pattern of invoicing your client and getting the cash flow, and the revenue recognition is completely different. Say, for example, I may say I invoice my customer 1 crore every half year. So, which means at the end of the 2 years, which is four half years, I would have invoiced only 4 crores. And I would have got cash. So what I invoiced would have been recognized as revenue. So debit debtors, credit revenue of 4 crores. But when I do this percentage of completion at the end of the second year, I said I can recognize a revenue of 5 crores because I have completed 50% of my work, 4.75 to 9.5. So I am theoretically allowed to recognize revenue of 5 crores, wherein I have done an invoicing of only 4 crores. So this 1 crore can be recognized as an unbilled revenue. So you debit unbilled revenue and credit revenue to the extent of 1 crore, so that my P&L will show a revenue of 5 crores. So it can also be ulta. So I would have probably invoiced 6 crores, but I can recognize revenue of only 5 crores. So in that case, that 1 crore of excess revenue I have billed, excess amount that I have billed cannot be recognized as a revenue. So you remove it from the P&L and put it into balance sheet as a deferred revenue or an unearned revenue. So we need to be very clear when it comes to an AS7 accounting that your billing pattern is different, your recognition of revenue in P&L is different. So you have your billing pattern based on your contract, you have your revenue recognition based on the principles of the standard, and if there is a difference, you either account for an unbilled revenue or you account for a deferred revenue, as the case may be. There could be one more complication which can come in. There can be multiple more, but one more which is very relevant is going back to the principle of prudence. What would happen if I estimate a loss? So again, going back to my example, initially when I started my contract, I said 10 minus 9, 10% profit. But because of inflation, steel prices increasing, political situation, my estimated cost becomes 10.5 crores. So which means, and it's a fixed price contract. Whether I can go and negotiate with my customer and get a revenue, I will deal with it as my last topic of discussion. But assume that you can't change your revenue. So there is a 10 crore projected revenue, a 10.5 crore projected cost, which means a 50 lakhs loss. So the standard says that if you have a projected loss, then that loss needs to be provided on day number 1, irrespective of your percentage of completion. So though in my example I say only 50% of contract is completed, there is another 50% of 50 lakhs of loss of 25 lakhs which I would incur at the end of the contract based on my present estimates. So that projected loss needs to be accounted the moment you estimate loss in your projections. So this is another important concept which is there in the standard and which is also based on the prudence. If there is an expected loss, when the total costs are likely to exceed the total revenue, we still need to do the loss as and when it is incurred or projected. The percentage of completion can be 0%. Even in that case, this 50 lakhs needs to be recognized as a loss. So the concept that we have covered till now is to understand how a percentage of completion can be determined, how the billing and revenue recognition is different, how do I do the computation of these two things and account for either deferred revenue or an unbilled revenue, and we also discussed on how we account for expected loss. And again, these are all things which is coming from an accounting standard perspective. When it comes to taxation, it's a completely different animal because of the ICDS implications. So what else could be? The whole challenge is coming because of the long-term nature. So if it is inventory, the turnaround time could be very less. So you just need to worry about the year-end cutoff. At year-end, value the WIP, value the FG, and do the NRV analysis. But here, since the project itself is going to be a long-term project, we have these complications. Again, the next aspect, what is there in the standard, going back to AS1 on prudence is, since it involves lots of estimates, because you estimate the cost, you estimate the period of completion, the standard also says, not in plain English, be conservative. Which means it says, unless you reach a particular level of completion, where you are sure that your estimates are correct, you will be able to execute the project on time, you will not have time overruns, you will not have cost overruns. It says don't recognize profit, which means you try to map the cost to revenue and be conservative. Say, generally the threshold we follow is about 25%. So look at the percentage of completion. If it is less than 20 or 25%, you recognize revenue only to the extent of cost and be conservative in not recognizing the profit. Because once you move ahead and once you become comfortable with the estimates you made, you can always recognize the life-to-date profit in the coming year. See, again, this 25% or etc. is just an example that I am giving you. But when you look at the standard, it will say be sure in terms of recognizing revenue because of the estimates which is involved. And if you are not very sure, then just map the cost and the revenue for the time being, which is in sync with the concept of prudence that we spoke about. So this is the paragraph. Revenue to be recognized to the extent of cost incurred, of which recovery is probable. We spoke about stage of completion, we spoke about reliable estimates. Okay, the other aspect that I was speaking about is whether we will be able to pass on the cost increases to the customers. See, I estimated 9, I quoted 10, I got the contract. But the situation has changed. Ukraine war, I'm not able to get my raw materials. Steel price has increased. So I'm ending up with 11 crores cost and a 10% loss. So will I be able to go back to my customer and ask for renegotiation of the fees? Practically, yes, we won't keep quiet. But when do we recognize it? See, as we all know, how does it actually happen is that we go, we need to submit bills, we need to justify, we need to have lots of discussions. It will go to and fro. He may ask for 10%, he may give only 2%. So there is a lots of uncertainty in terms of when this negotiation would complete and how much you will get. So again, going back to AS1, you be conservative and prudent. So if it's expense, the loss, as I said, you provide immediately, but income, you try to recognize it only when you are reasonably certain that you will recognize. So this industry works on such kinds of negotiations and such kinds of additional billing, but that both sides, both from the company side as well as from the audit side, we need to be clear in terms of ensuring that I will have no uncertainty in collecting this extra client, and once you reach that stage, you recognize revenue. Till that time, nothing will happen. It will just be your balance sheet item, and you can recognize it as and when you are convinced. So that's why even AS29, it will say provide for any losses, but when it comes to contingent asset, it says don't even recognize and disclose. So these are, yes sir.
The contract has a warranty claim to be made. When do I recognize the warranty claim?
Sir, I have seen it happen two ways. When you should recognize warranty would be from a matching concept perspective as and when you recognize revenue. So in my example, if you have recognized 50% of revenue after year 2, and if there is a 2% warranty that you have agreed, then the 2% on that 5 crores will get recognized as and when I recognize the 5 crore revenue, so that there is a matching concept. So because this warranty is going to come because of the revenue that you have earned. So it has to be as and when the revenue is earned. But in this kind of industry, what I have also seen is, when I say the estimated cost, they also inbuilt warranty as a cost, which indirectly means I will recognize the cost as and when the revenue is recognized. If I have to put it the other way around, just postponing this 2% only to recognize this cost only after handover is not possible. You will have to recognize this cost as and when I incur the revenue. As and when I recognize the revenue. So these are certain concepts from an AS1 perspective: percentage of completion and completed contract methods, the different manner in which I recognize the percentage of completion. Estimate surveys could always help, but the generally accepted model is to have the percentage based on actual cost to the projected cost. We understood the challenges that could happen when it comes to the projected cost, which can always be changing. So we understood how the true up needs to be made at the relevant financial years. We spoke about how to provide for loss provision. We also did a comparison between my billing and revenue, and we discussed and understood if there is an excess revenue or an excess billing or a lower billing, how do we account for it in the balance sheet? And all these things needs to be disclosed in the financial statements. How much you have recognized, what is the method of recognizing contract revenue, cost, how have we done. Advance and retention, it's very typical of this industry. So you account the advances and retention based on the requirements of Schedule 3, and you also account and disclose the amount due to and amount due from the customer. The crux point is, from a control perspective, you need to have a control on the company or your client as to how they determine the cost, because that is the most vital aspect which will drive the entire accounting when it comes to an AS7 accounting purposes, because it's going to be done on a judgmental basis, which again arises because the time period that you take to complete the contract. So that's it from me. So we started the discussion by discussing about NCEs, the classifications, the levels, how do you determine the levels, the standards applicable, and the relaxations available. And we also discussed certain key concepts when it comes to an NCE. And then we started discussing about 3 key standards, 1, 2, and 7. And we understood what does the standard provide, and what are some practical challenges in implementing those standards when it comes to accounting as well as disclosures. So thanks a lot.
I have a question on the
Yes, sir.
inventory. You are able to hear me.
Yeah, I'm able to hear you, sir. Go ahead.
I manufacture a product specifically for a customer, and it is in stock, and I know the selling price. It is only to be shipped. Can I value it at the selling price? Because I know it is going to be recognized as realized value and is specifically made for a particular person.
Okay, I think everybody heard the question, right? So if there is a product which has been manufactured specifically for a customer, where I have a contract which will determine the selling price, can I value that product at the selling price and not at cost? Any thoughts?
At cost.
Why?
The risk is not yet transferred. Though you have identified it, you have not transferred the risk.
Okay. Any other thoughts?
Unless income is recognized, realized, you should not recognize it.
Yeah, even I would prefer that it suggest that it has to be done at cost, because though you have a contract, I do not know the terms and conditions of the contract to see whether it can be cancelled or not. Yes, cancellation in this case would have lots of penalties because you have manufactured the product only for him based on his design, his requirements, his technology. But the actual ownership or the control as defined under AS9 has not happened here. So I would still suggest that it needs to be valued at cost, and you just cannot value it at the possible realizable value. Again, going back to AS1 and principle of prudence, and combined with AS9, wherein it says the risk and reward should get transferred. Hypothetically, what would happen if you recognize the revenue? You are going to ship it only after 2 months, but within these 2 months, the product gets damaged. Okay, you always have insurance, you always have recoverability from your customers. That is more a risk mitigation for the product, and it is not in line with the AS9 revenue recognition requirements. So I would still value it at cost and do the revenue recognition only on shipment. Anything else? Any other practical situations under 1, 2, and 7 that you have experienced would be good to discuss?
You mentioned in AS7 the project completion method. AS7 no more recognizes
Yeah.
project completion. It's only recognizes percentage completion.
Yeah, that's right. Yeah. So thanks a lot. Nice meeting you all this evening. So these are my phone numbers and my mail ID. Would be happy to connect with you in case if you have any other queries, either on this topic or any topic of accounting interest. So thanks a lot. Have a nice evening, and thanks for a very patient hearing.
Sir, thank you for a wonderful session, sir. Raghu sir, and sir, please sit up, sir, one second. Vote of thanks can give a Raghu sir, sir.
Completed well ahead of the IPL match.
Dear members, at the outset, I thank SIRC for having given me this opportunity to present the vote of thanks. My sincere thanks to Sri P. Shankar Raman for the extensive coverage of AS1, 2 and 7 and also the macro aspects of various other standards. Thank you very much. Before I wind up, I have a small request to SIRC. Please make available the background material of this to the members who are
sure.
present here as well as those who could not be present here because of these other reasons. Thank you. Good night.
Yeah, thank you so much, sir.